Hello guys, you're welcome to my YouTube channel. So in today's video, I'll be diving into the basics of forex trading and how to equip you with the knowledge you need to kickstart your trading journey. So whether you are a beginner or you already have little experience about trading, this video is designed to demystify forex trading and help you become confident and informed trader. If you have questions, feel free to drop in the comments, and you can also give recommendations of new videos you want me to upload. So make sure you watch till the very end, because I'm going to try my best to make this particular video simple and straightforward. Let's get straight to what we have. In this video, we're going to understand what forex trading means and how you can actually make money trading forex. And after that, we'll talk about currency pairs, we'll talk about time frames and trade sections. We're also going to talk about lot sizing and how it is very important for you as a trader. We're also going to talk about PIP calculation, stop loss and take profit. We'll talk about spread and leverage. So don't miss out on everything I'm going to explain here, because they are very important and it will help you in your trading journey. So what is forex trading and how do we actually make money trading forex? So from the screen you can see we have forex trading is the buying and selling of global currencies. It's how individuals, businesses, central banks and governments pay for goods and services in other economies. Whenever you buy a product in another currency or exchange cash to go on a holiday, you are trading forex. Now the second paragraph explains what we actually do as forex traders. This is more like the practical aspect of it, what we do in our everyday life. That is what the first paragraph is actually talking about. And for the second paragraph, you can see, however, a significant proportion of forex trades aren't for practical purposes. Speculative FX traders seek to profit from fluctuations in the exchange rates between currencies, speculating on whether one will go up or down in value compared to another. So this is actually what we do as forex traders. And if you're looking to start forex, that is also what you will start doing as a trader, because what we do here literally is that we speculate whether a particular currency is going to push up or down. And in a situation where we speculate that a particular currency should push up and it pushes up, we're making money. And then if we speculate that a particular currency should push down and it pushes down, we're making money. But once you speculate and it goes against your speculation, just know that that is when the loss will come in. So that is literally forex trading. We are speculating between two currencies whether it's going to push up or down. So you'll get to understand once we go into the next thing we have, which is currency pairs. Now, looking at currency pairs, you can see a forex pair is a combination of two currencies that are traded against each other. So example, we have the euro against US dollar, which is the euro USD. Then we also have the US dollar against the Japanese yen, that is USD JPY. And we also have the British pound against the US dollar, which is GBP USD. So you can see from here the base currency is always on the left of the currency pair, and then the quote is always on the right, which shows how many of the quote currency it will cost to buy one of the base. So when you are trading currency, you are always selling one to buy another. So like I stated earlier when I was explaining what forex trading means, I stated that how we actually make money trading forex is by speculating whether a particular currency is going to push up or down. Now if we speculate that it's pushing up, we're making money, right? So now we're looking at currency pairs. Now currency pairs, now that is actually what we trade in the market. And now when trading currency pairs in the forex market, you cannot just trade one particular currency. It must be paired to two currencies, must be paired together. So hence the name currency pairs. So you can see from our examples, we have euro USD here. So that simply means if we are trading euro USD, we are trading two currencies here, which is euro and US dollar. And we also have US dollar and Japanese yen. We also have pound and US dollar. If we are speculating for euro to push up, that simply means we're also speculating for US dollar to push down. So because two of them cannot be pushing up at the same time, if we are speculating for euro to push up, US dollar needs to be pushing down. So that is why this statement is here. It shows how many of the quote currency it will cost to buy one of the base. When you are looking at a currency pair, the first currency is actually what we call the base currency. So you can see it from here. Using this illustration here, euro USD, these are actually two currencies currencies paired together, euro and US dollar. So the euro, which is the first currency you will see, is the base currency, and then the US dollar, which is the USD, the second currency, is actually the quote currency. So let's head straight to the chart and I'll show you how it is represented on the chart. Looking at it from the chart, we are currently looking at GBP USD. We're currently looking at GBP USD from the chart. So I actually customized my own chart to, blue and black. So once you also download your own trading app, it will come with the default color of red and green. So you can also customize according to your choice. What I'm trying to explain here is, you can see here now we are looking at GBP USD, and GBP here, which is pound, you can see it here, British pound, represents the base currency, and then USD here, which is the US dollar, represents the quote currency. How it is represented on the chart is, you can see on this chart we have different, what you can see here, we're looking at the chart and this is called candlesticks. So this is called candlesticks. So looking at it, you can see we have two colors here. We have the blue color and we have the black color. So for the blue color represents British pound. So like I stated, I want to make it very simple for everyone to understand. So the blue color here represents the British pound, and then the black color represents USD. So if you can recall, I stated that if we are speculating that British pound should push up, that simply means we are expecting this one to push down. So if we are speculating for British pound to push up, these two currencies paired together cannot be pushing up at the same time. So if we are speculating that GBP USD should increase in price, that simply means we are also speculating that US dollar should reduce in price, because if two of them are increasing, we are not trading. So one must be reducing and one must be increasing. So if we are saying that one should increase in price, which is if we say that the base currency should increase in price, that simply means we want to buy. And looking at the chart, that simply means we want the blue candlesticks to start pushing up. So you can see from here we had more of increase from the British pound, and you can also see from here, just like this, long candlesticks, this simply means that US dollar, which is the quote currency, was actually doing well or doing better than the base currency, because US dollar was increasing in price more than GBP USD, and that is why you see that of the US dollar pushing down. So also have it in mind that the first currency you see on each currency pair is called the base currency, and the second is called the quote currency. This is what you need to understand about currency pairs. So if you go here, you will see different list of currency pairs. So here we're looking at USD JPY, is still the same thing. So you can see from here now, US dollar is actually the base currency, and then JPY, which is Japanese yen, is actually the quote currency. So looking at it, you can see we have this long candlestick here. This simply means that US dollar increased in price more than the currency paired to it, which is JPY. So that's why it's pushed up. So if you as a trader speculated that this should push up and this type of movement happened, you'll be making a whole lot of money. And same thing is applicable when you also speculate that it should push down and it pushes down, you'll be making a whole lot of money. So that is it for currency pairs. So we're going to be talking about time frames now. A time frame in forex trading can refer to any designated unit of time in which trading takes place. Typically, forex time frames will be measured in minutes, hours, days, or weeks. You will choose the time frame that is most suited to your trading strategy. We actually have different types of traders, and the type of trader you are will now determine the time frame you will be trading from. So we have scalpers, we have day traders, and we have swing traders, and then we also have position traders. These traders, they have time frames that are suitable for them. So when you start practicing, you will get to understand the type of trader you are and the time frame that is suitable for you. From the charts, we have the monthly time frame, we have the weekly time frame, we have the daily time frame, we have the 4 hour time frame, 1 hour, 30 minutes, 15 minutes, and 5 minutes, 1 minute. So let's go to the chart so that you still understand how this is presented on the chart. So looking at it from GBP USD now, so you can see from here, I have list of time frames that are more like I use them to trade. So I added them to my list of favorite time frames. So you can see the stars here, they are all starred. But if you check here, we have list of time frames. And what is the idea behind these particular time frames? Now, currently we are viewing the chart of British pound and US dollar. We are viewing the 15 minutes chart. And what does that mean? That simply means that each candlestick here represents what has happened within 15 minutes. That is what it means. Each candlestick here represents what has happened within 15 minutes. So this long candlestick, this happened within 15 minutes. Even this small one happened within 15 minutes. So something is applicable. Let's look at 5 minutes time frame. This particular time frame now, this is 5 minutes. It simply shows that each candlestick represents what has happened within 5 minutes. So that is it in trading. Something is applicable when you go to the daily time frame. The daily time frame represents what has happened in one day. So each candlestick represents what has happened in one day. So if you touch it, you will see that from here now you can see we have Thursday, Friday, Monday, just like that. So just if you move to 1 minute, it also means that represents what has happened within 1 minute. Same thing with that of 1 week and the rest. If you now get to understand the type of trader you are, then you will know the time frame that is suitable for you. So this particular topic on the time frame suitable for different types of traders, just like I listed that we have scalpers, day traders. So this, I will talk about this in my next video. So make sure you watch that so that you will understand the type of trader you are and then the time frame suitable for your trading style. The next one we have is trading sections. So what does that mean? Forex trading sections refer to the periods of time during which the foreign exchange market is open for trading. There are 4 main trading sections in the forex market. Number 1, we have the Sydney section, we have the Tokyo section, we have the London section, and we have the New York section. So you can either say that we have 4 trading sections, or you can just say we have 3 trading sections, because the Sydney sections and the Tokyo section combined together is called the Asian section. I'm going to explain how this works and when the one that is more like very important for you as a trader, but it's all left for you once you start practicing. It's all left for you to decide the one when you should be trading, whether you want to be trading during the Asian section, London section, or the New York section. Working with London timing, that is GMT, when we are talking about the Sydney section, remember I said the Sydney section and the Tokyo section combined together is called the Asian section. So if you're looking to trade during the Asian section opens from 10 p.m. Then it will move all the way down to 12 a.m. 12 a.m. Tokyo section will open, merge together with the Sydney section, and from there it will be open until 8 a.m. After 8 a.m. the Asian section will close. Then 8 a.m. immediately London section will open, and that will remain open until 1 p.m. where it will merge with the New York section for like 1 hour, and after that the London section will close and we will just have the New York section. So that is how it moves. From the Asian section, it will go into London section, which is the morning hours. Afternoon hours will go into New York section. Then midnight, evening hours will go into Asian section. That is how time frame works. So you can see from this illustration we have here, you can see the London section. It starts from 8 and it will move. You can see where it lapped with that of the New York section. That is from 1, and then immediately around 3 or something, then it will close. We'll just have the New York section open. Then around 10 the Sydney section will open. Around 12 the Tokyo section will open. So that is how it moves. Now, when can we say that market moves faster? So for me personally, I love trading during the London and New York section. During Asian section, market is kind of slow. But during London and New York section, the volatility you need in the market, you will see it because market will be moving faster. So that is when I can advise you to trade. But if you also like it when market is moving slowly, then Asian section is for you. So that is it for trading section. The next one we have, we're going to talk about lot sizing. Pay close attention to this particular one because this particular topic, lot size, will determine how much you make as a trader and how much you lose as a trader. So it's a very important topic. Most traders, even those that do claim that they already know what they are doing in the market, most of them don't understand the importance of lot size. So make sure you pay attention to this because understanding this will help you protect your capital in the market and will also help you grow your capital in the market as a forex trader. In forex trading, lot size refers to the amount of currency you are buying or selling in a trade. So there are 3 main types of lot sizes in the forex trading. So we have that of the standard lots, we have the mini lots, and we have the micro lots. When we are talking about standard lot, that's simply means you're more like trying to trade out from 100,000 units, which ranges from one lot size, 2, 3, 4, infinity, all the way down. So counting it from one lot size simply means $10. So when you're trading with one lot size, that simply means you're risking $10 per pip, $10 per movement. So if you're speculating that price should push up, now when price is trying to push up, we call that pip movement, which is, like I stated, which is the next slide we're going to look at. So pay close attention. So when we're talking about pip calculation, or when you're trying to speculate for price to push up, that simply means it does not just push up like that. It moves pip by pip, or step by step. Let me just use that step by step so that you understand it. Or we actually call it pip. It moves step by step. And now, if you are trading with one lot, that is from the standard lot, that simply means you are risking $10 per movement. So that simply means one movement, if the market should push up and give you one movement, it will give you $10 in profit. So it now depends on how many movements you want to catch. Then you can now multiply it and view how much you will make as a trader. So same thing with that of the mini lots. You can see what we have here. If you're trying to trade off the mini lot size, that simply means you want to trade 10,000 units of your capital. So that is more like, we have from mini lots, it ranges from 0.1 to 0.9. So that simply means 0.1, the dollar equivalent is $1, all the way down to 0.9. So that simply means 0.9, the dollar equivalent is $9. So if you're looking to trade this, if you're looking to trade with 0.1, that simply means you're risking $1 per movement. And you use this particular lot size depending on your account size. That is where the risk management in trading comes in. That is where you now handle your capital well as a trader, because your capital size will determine the lot size you will use. If you use any lot size that is bigger than your capital, that simply means you are risking too much, you are over leveraging, and that is when you can see all your money will disappear. So we also have that of the micro lot, which is the lowest. So we have, it ranges from 0.01 all the way down to 0.09. So this one we are talking about cents. So if you're trading with 0.01, that simply means you're risking just 10 cents. Same thing is applicable to, all the way down to 0.09. That simply means you're risking 90 cents. So that is it for lot sizing. If you have any question, remember, don't forget to drop that in the comment, and don't forget to subscribe, turn on the notification bell so that you'll be notified when next I drop videos, because this channel is only centered in teaching you forex trading and making you understand everything you need to know about trading, and at the end of the day you make money with trading, because it's not just about you knowing the theoretical aspects of trading. After understanding the basics, after getting the theoretical aspect of it, you head straight to your charts and make money with it. That is what makes you a forex trader. So the next one we have to talk about is pip calculation. So remember I said if we are speculating for price to either push up or down, it does not just push up. How do we get to know how many points? How we get to calculate that is, we call it pip calculation. So market moves pip by pip. In forex trading, a pip is the unit of measurement used to indicate the change in value between two currencies. It stands for percentage in points, or price interest point. So the calculation of pip value depends on the currency pair being traded, and the lot size of the trade. So you can see they move hand in hand, lot sizing, and they move hand in hand. So now pay close attention to this particular picture here, because it's going to explain everything you need in calculating your pip. And after that, I'll still go to the chart and show you how to calculate your pip with trading view chart. So looking at it from here, if you are looking at currencies or currency pairs that does not have JPY on them, that is the Japanese yen, any currency pair that does not have JPY on them, if you're looking to calculate the pip, you can see where the green color is. The green color simply means where the pip calculation is. So normally the last color, which is painted yellow, is called pipette, and it's not that important when we are trying to calculate the units of measurement. So if you want to calculate the pip manually, you can start from here, taking away this last number. Then you start from the last number after the decimal point. You start from here to calculate your pip. So if you want, let's say if you're trading Euro USD and you want Euro to push up against USD like 10 pips, all you just need to do is this particular market price. Now let's say if this is where market price is, because obviously as the market is moving, the price is changing. So I'm just using this price as an example. If this is where market price is, all you just need to do is add 10 to it, and we'll get where our take profit will be. So let's still go to the charts. Let me show you guys how to calculate PEEP with your trading view quickly without wasting time. Okay, before we do that, currency pairs with JPY on them, you can see how the numbers are. Is very, it's different from this particular one. You can see how the numbers are. You will also do away with the last number and then work with the second number after the decimal point in calculating your PEEP. So let's start from the JPY pairs. Let's look at GBP JPY, for instance. So this is GBP JPY. If we want to calculate, okay, let's say from here now, we want to know, as price pushed down from here, we want to know how many pips price actually used, the number of pips price pushed down with here. So all we just need to do is, if you come to you can see here, this is trading view. I'll also drop a video explaining how to navigate your trading view if you don't know how to. So if you come here, all you just need to do is pick either your long position tool or your short position tool. If you are trying to check why price reduced, like why there is a bearish move, a push to the downside, you will use the short position. Then if you're trying to know why there is a push to the upside, you will use the long position. So that simply means if we are trying to say that the base currency should reduce in price, that simply means we are trying to short, we're trying to sell. If you're trying to speculate that price should increase in price, that simply means we are trying to buy, which is we're trying to long. Now we want to know why the base currency, which is the black candlestick, why it was actually doing better than the we want to know why the quote currency, which is this black candlestick, is actually doing better than the base currency. Because when we're looking at the chart, the base currency, how I put it, is more like the base currency is more like the owner of the chart. So when it is pushing up, that simply means the base currency is doing well. But when the base currency is not doing well, then the currency paired to it will now start doing well, and that is when you will see there will be a push to the downside. So now we want to know how many pips it has moved. So with this position tool, it's going to tell you everything. It's going to tell you, let me just place it here first. With this position tool, I also customize this to the color of my choice. So you can also do that when you download your trading view. So with this position tool, this ash side, I'm going to put both the long and the short tool. So this is for long, when you are trying to speculate for price to increase in price, for market to increase in price, and then this is for short when you're trying to speculate for market to reduce in price. So now this ash side is the stop loss side. So if we go back to our slides, you also understand what I mean by stop loss. So, or let me just give a little explanation about it, so that when I'm talking about it, it will also go in. So stop loss simply means, remember when I was explaining forex trading, I said we are speculating. So if we are speculating for price to push up, we should also prepare for what will happen if price does not move to our direction or does not go according to our speculation, and that is stop loss. That is how you get to protect your capital. You just take a certain percent of your account, risking it, and your stop loss will determine that percent you're risking. So this ash side shows the stop loss. Now for the short position, now this blue side shows where that's our take profit side. If we are speculating for price to push down, this is where we want it to get to. This is just where I place it now. This is where we want it to get to. Then it will close our trade in profit. Or if it goes against us, this is where we want it to get to, and it will close our trade in loss. So that is it. So now this, once as I'm clicking on it now, you'll see there are numbers here. Now if you want to know the number of pips, it's very simple. From how I placed it now, the stop loss of this particular trade, so let's say you can see from here, we have this number here, this number at the center. The stop loss is 61 pips, and then if we're looking at the take profit is 246 pips. So instead of having to trying to calculate the number of pips manually, all you just need to do is place a position tool from your entry, and then everything will be calculated for you easily. So you can see the ash side represents the stop loss zone, the blue side represents the take profit zone, and then this line demarcating the ash side and the blue side represents your entry price. Entry price simply means where market was at when you decided to place your trade, and when you decided to go into the market to speculate and place your trade. So that is how to calculate your stop loss and take profit using this position tool in the market. Remember, it's more like a reminder because I love it when you ask me questions. Go ahead, drop your questions in the comments so that I'll be able to answer you and make sure the aim is for you to understand everything clearly. So if there's anything confusing to you, drop that in the comments. Ask your questions. We must make money together in the forex market. So let's go back to our slides. The next thing we have take profit and the stop loss. I was just talking about it, as I was trying to explain our people. Take profit is a predetermined price level at which a trader chooses to close a trade in order to realize profit. It is the price point at which a trader wants to exit a trade and lock in profit. Then we have stop loss, which you can see is abbreviated as SL. Take profit abbreviated as TP. So stop loss is a predetermined price level at which a trader chooses to exit a losing trade order to limit the amount of loss incurred. It is the price point at which a trader is willing to accept that the trade has moved against them and cut their losses. So I just stated that, I just explained that as we were looking at the chart. I said, if we are looking to, or if you are speculating for price to push up, there must be a level where we want price to get to. If it gets to that place, that is where we want to bring out our profit. So the take profit and the stop loss, for the take profit, if price eventually gets there, it will just close your trade automatically. Same thing with stop loss. If price eventually gets there, let's say you're speculating for it to push up and it goes against you and started pushing down. If price gets to where you put your stop loss, so the stop loss simply means if price does not want to go in my favor, if it's going against me, it gets to this level, let it close and bring out a little loss from my account. Then for take profit, if price is indeed going to my direction, let it go there and bring out profit for me. So that is the essence of take profit. And it is important for you as a trader to always trade with your take profit and stop loss. Apply that, learn it. Remember, your take profit is there to book profit for you and your stop loss is there to tell you when you are wrong, and then you will leave the market immediately without having to lose more than you are willing to lose. Because remember, once it comes to forex trading, you must be ready for both the losing part and the winning side. So don't just come in because I want to make money, I want to pack all the money for the market and leave. No, in trading you will still lose. So just have that in mind, and what makes you a good trader is now how you manage your losses and your wins. That's why your take profit and stop loss is there. What you are trying to risk, what you are trying to lose should be, lower than what, how am I going to put this now? So what you are trying to make should be higher than what you're risking. So let's say if you are risking, let's say 1%, you should be targeting 5%. It is that important. So that is it for take profit and stop loss. Then we are going to talk about spreads now. So this one comes in when you are placing your trade. So from what we have here, you can see in the forex market, the spread refers to the difference between the bid price, that is the price at which a trader can sell a currency pair, and the ask price, that is the price at which a trader can buy a currency pair. Essentially, it is the cost of placing a trade in a particular currency pair. So the spread is typically measured in pips, and the size of the spread can vary depending on market volatility, liquidity, and the broker being used. So a tighter spread is preferable for traders as it means they can enter and exit trades at a lower cost. So obviously what we mean by spread is when you are trying to place trade, when you are trying to more like speculate whether you want to buy or sell, if you click the buy button, there is something called spread, which is what we have explained. We have the ask and the bid price. So now what makes, remember I said from here, you can see the last line, I said the tighter spread is preferable for traders. So it's more like the gap between the bid and the ask price. So, and this is mainly, it all depends on, number one, the volatility of the market and the broker being used. So that's why it's also important for you to pick a good broker that will have a tight spread, because in a situation where you start trading in a wide spread, you can decide to buy from this particular level, and once you place your trade, instead of the market to place your trade at that particular level, it will go to another level that is not where you're actually looking for, and place that trade, and then you'll see your trade will be running a massive loss before it will even go into profit, and that is not advisable. So that's why when trading, you should also make sure you are trading with the right broker that will give you a tight spread, and then The volatility of the market can also increase spread. Something like when news comes out, that is fundamentals, which we'll also talk about maybe in our next video. When news comes out and all these economic events trying to move the market, so that can increase the spread in the market. And this is also important for you as a trader, so that if you want to enter the market at this level, if you place your trade, let it move from that level. Not if you place your trade, go and place it for you here, or if you want to sell, to go and place it for you here, changing your entry. That's what spread is there for. Then another thing I would love to talk about today, we have that of the leverage. Now you can see from the screen we have in the forex market, leverage refers to the practice of borrowing funds to increase the size of a trade. It allows traders to control larger positions in the market with a smaller amount of capital. Leverage is typically expressed as a ratio such as 1:50 or 1:100, which indicates the amount of capital that a trader can control relative to their initial investment. While leverage can amplify potential profits, it also increases the risk of significant losses, as traders can incur losses that exceed their initial investment. Traders should use leverage cautiously and be aware of risk involved. So for leverage, what am I actually talking about here? Now, I guess if you've been if you've seen more like people talking about forex, someone can tell you, I deposited $50 and I was able to make $100 with that particular capital, or even make more. So leverage is more like money that your broker, and in the next page we're going to talk about brokers. So leverage is more like money that your broker will add to your initial investment. That is, if you decide to, let's say, fund your account with $100 now, depending on the leverage you choose, your broker will be able to add that particular leverage for you. So let's say if you choose, just like we have from the example here, from the illustration here, the picture here, this is leverage of 1:100. So let's say you are trading $100 account. That simply means if you are trading with leverage of 1:100, your broker will more like increase your account to this level virtually. So that simply means you can trade with lot size of a trader that is trading with $10,000, while your initial capital is actually $100. So remember, it is good and it's also bad. So you can see what I said, it also increases the risk of significant losses, as it can also amplify your potential profit. So it can give you profit in the sense that if you're in the right trade, you can use that and even flip your account. You can see yourself making 100% of your account or even more because of the leverage you have. And with that, with the leverage too, you can also see yourself losing everything you have in the market. So that's why at the end of the day, proper risk management is always advised. So that is it for leverage. Then the next one we'll talk about, which I will be wrapping up this particular video with, we're going to talk about forex brokers, because after everything, remember I said it is not just about the theoretical aspect of trading. You're not here to know what forex means and the rest. You are here to know what forex means and use it to make money. So you're not just here to know that forex simply means we need to speculate this. We are not here because there's no time for you to start writing the exam. Your exam is you going to your chart and making money with it. That is your exam. So if you're looking to start, you must actually pick a broker you're going to trade with. So in order to make you understand what broker means, it's just like how we have different banks. So currently I'm in Nigeria. So in Nigeria we have different banks. We have like First Bank, we have GT Bank, that's Guaranty Trust Bank, we have Access Bank. So you can see all these banks, they are literally doing the same thing. They are doing the same, just like we have our banks. They are doing the same thing. What do? They help us keep our money, and whenever we need it, we can decide to withdraw, or we can also add, we can use it to do our savings. So that's exactly what forex brokers, they do in the market. If you're looking to trade, there must be somewhere you deposit your money and start trading. So that is actually a broker, and there are a whole lot of brokers. So I'll be dropping the link to my own broker in the description. I trade with Octa Broker. So the link will be there. You can go ahead, click the link, use that to create your own account. You create your own account and make your deposit. You also get a bonus which will double your first deposit. So the link will be in the description. So you can just click that and open your account with that forex broker and then start practicing. So from what we have here on the screen, a forex broker is a firm that facilitates trading in the foreign exchange market by executing buy and sell orders on behalf of clients. Forex brokers provide traders with access to the forex market where they can trade currency pairs and speculate on price movement. So like I said, that if you're looking to trade, you cannot just carry your phone and start trading. You must deposit to a broker, and from there you'll be using your money small to trade. And if you also want to withdraw, it is also your broker that you will withdraw from. So I hope with the basics I've talked about here, we started from what forex means and everything. What forex means, we talked about currency pairs and the rest. So with this, you've been able to understand more, like you've gotten a clear picture of what forex it's actually all about. This particular video was meant to like equip you, open your eyes to what forex trading means and how you make money with forex trading. So hope you enjoyed this video, and remember, if you have any questions, drop them in the comments. I love it when you ask me questions. Drop them in the comments if you have any questions, and I will quickly respond to you. So guys, thanks for watching. Don't forget to subscribe to my YouTube channel, because more videos will be dropping. Turn on the notification bell so that you'll be the first to be notified when next I drop video. And also don't forget to like so that this video others can see it. So thanks for joining, and bye for now.